The Bharat-22 ETF, it's had a strong listing on the bourses today. The idea behind the Exchange Traded Fund was to bring in retail investors. That's according to ICICI Prudential's Nimesh, Shah, who manages the fund. In a conversation with BloombergQuint's Yatin, Mota, he talks about the valuations and the selection criteria for the stocks. Hear him out.
When we had gone about selecting the companies in the index, each of the companies we had said what is the scope of this company over the next 3 to 5 years. Right? Government of India is doing, since private sector capex is not happening, Government of India is capex is quite active. Another point that is there in the market is that a lot of amount is being spent on infrastructure. Right. So we have gone about that with this government initiatives, which are the companies that are going to benefit. Also, as you have seen that the management of these companies is also being done, they are trying to beef up the management of these companies also. Okay. With all these efficiencies will come in cost, there will be better revenues for these companies. That's what we expect. So we have gone about that, and that will result in a better EPS over the next 3 to 5 years. Okay. Whatever the government is doing today will benefit not only in the 17-18, will benefit 18-19, will benefit 19-20. So I think there is and with the earning per share increasing and the market getting convinced that these companies are being managed better, are being managed much better, there is a good chance of these companies getting re-rated on the PE side also. Okay. So what we have in mind when we wanted retail to invest was not this that on listing you'll get 3-4% more. Okay. That was not the only idea. That was one sweetener that the government of India has put in. But frankly, somebody should invest in this ETF now if they are convinced of what the things that I said, that the government of India is serious about these companies and wants to manage these companies better than they were been managed in the past. And we have seen the early signs. The last 3 years we have been seeing it that they have been managed better. So if you believe in that thing and if you believe that this revenues and the cost can come down and the revenues can go up, then both EPS expansion and PE expansions in these companies are possible. That's what we believe as ICICI Prudential.
And if you look at the design, of course, you said that the companies will be managed better, and we have most of them very large companies amongst the PSU stocks. So do you think return-wise on the benchmark indices, these kind of funds can outperform moving forward, given the fact that we have a healthy mix of strong PSU companies in the basket?
See, that's what the whole structure was. That when we had created the index, that was the government of India idea was also that because they wanted to attract retail investors. See, if the government wanted to divest, it could have always done a institutional issue, and foreign institutional investors or the institutional investors would have invested in it. Their whole idea was to get the common man of India in. Right, so they were very conscious that they come at the right price and companies with good future.
Okay, and one final question on the expense ratio, really, because as an investor, one is worried that how will the expense ratio shape up, how will the performance of the fund shape up, because again everything is a function of returns for the investor. So in terms of the expense ratio and in terms of management fee, how does a company like ICICI Pru AMC look at this product, and if you could share some numbers with us.
So investors should be very happy because this is one of the lowest expense ratio possible. Right, there is nothing in it. As far as the retail investor is concerned, it's a good bet for the retail investor because he's not getting, hardly there is any expense on it. Very, very negligible, less than a basis point.